Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Investors trying to claw their way out of recent worries about overvalued tech companies, stagflation. Apollo Global Management President Jim Zelter joins us now. Jim, wonderful to see you. Thank you so much for being here.
Always nice to be here, Lisa.
So let's start with the look ahead for next year, which is everything is awesome. And what we're hearing from every single person who comes on the show is that next year is going to be double-digit gains in the S&P 500 at the same time that you continue to grind out better returns from the debt space. Is there a contradiction here?
Well, I would just say that the confidence sitting here in December about next year that anybody puts forth has to be taken with a little bit of skepticism because of the year we've just had. If you were here on this journey this year, obviously it's been a tremendous amount of volatility, and we've ended up in a place that many probably wouldn't have predicted. But as we sit here right now thinking about the year ahead, you're going to end this year with an extremely strong M&A calendar and M&A backlog in terms of what's actually been executed this year, but also in the pipeline of new deals. The expectations on the Bloomberg economics page is a 30% chance of a recession next year, a little bit higher inflation, a little bit lower growth. And as we talked about a moment ago, one of the markets has to be wrong. In this intersection right now where many are saying we need to lower rates because of an economic slowdown, and the other side saying earnings upside because of accelerating earnings from the Mag 7 and the 493, those both can't be correct, or it's very, very unlikely that they'll both be correct. We're in the camp at Apollo, as Torsten's been up here and many others, that between the K-shaped economy and other demographic issues, we're going to probably see a deceleration of lower rates and a stronger economy in terms of M&A, CapEx cycle, positive regulatory backdrop, and things of that nature.
So if bonds and stocks can't both be right, and they seem to be in conflict right now, are you saying that stocks have it right and bonds have it wrong?
I'm saying what's been surprising to all of it, if we take a big step back the last 4 or 5 years, the idea that the Fed would raise rates so much that they did, starting in 22. We all predicted massive slowdown in the U.S. economy, tightening financial conditions, and we were all wrong. This U.S. economy has been amazingly resilient. Now, it's been resilient for organic reasons as well as a lot of fiscal spending, obviously now the CapEx cycle, but the U.S. economy has been the most resilient for a variety of reasons, and our suspicion is that will tend to continue in the year ahead. So I think if you look at the gap in the last month or so of the Mag 7 earnings growth and the 493, a year ago it was like 30-35%. The growth rates of the Mag 7 and the 493 in the last quarter was 11%, 22 versus 11, I believe. So the rest of the U.S. economy is doing somewhat better in light of the breadth of the AI cycle.
But how much is this really all predicated on the ongoing funding of the AI cycle? I mean, this is sort of the fear that you're seeing baked into markets right now, is that there's a lot of debt coming into the space and everything is leveraged to AI being the solution to absolutely every problem that we have.
Well, I think you need to separate that a little bit. On the equity side of the AI activity, and Anne-Marie mentioned it at the start, certainly you've got the incumbents that have amazing business models, whether that's Alphabet, Meta, and the other Microsoft and Amazon. And then you've got the upstart, OpenAI. They're all coming from a different situation. The 4 or 5 have incredibly strong balance sheets and incredibly strong CapEx and free cash flow, which they're going to allocate to the AI equity story, because for them it's an existential issue. So for that's the equity side of the equation. What you're really touching on is this question of the 5 to 7 trillion that's expected to be needed to fund the data center and infrastructure CapEx of the next 5 to 7 years. That's been the zip code of the numbers being bandied around. And today, if you look at that number in aggregate and take a step back back again is the industry. Of that $5 trillion, about $1.5 trillion will get funded from free cash flow of the hyperscalers. The next $1.5 trillion will get funded between project finance, private capital, and a variety of other debt markets. About $1 trillion and $1.25 trillion will get done by the high-grade investment grade market. So it leaves about $1 trillion, $1.5 trillion. Where is that going to get financed? That's a question mark. What's the clearing price of that paper? And so, we spend a lot of time thinking about that. Those are the big picture moves that will really have an impact on pricing of the IG market, pricing of the high yield market, pricing of investment grade private credit. That's the big question that we're all grappling with if you're in these markets today.
Last time you were on, you talked about how financing these data centers is fundamentally different than in the past financing other technology projects. Why? Why are they so different?
Well, the last 30 years in the U.S. high yield and leveraged finance market, for the most part, you've been financing companies that were disruptors, but they were not investment grade disruptors. Think of the cable companies, think of healthcare companies, think of gaming, even companies like MCI and the regional airlines. This time, with the hyperscalers, again, if you look at the balance sheets of Microsoft and Google and Amazon, these are some of the greatest companies we've ever seen. $300-400 billion in revenues, $150 billion a year per company in free cash flow. So there is a counterparty to those businesses. You're willing to take on much longer duration risk if they are the tenant counterparty than you might have been at an upstart MCI or an upstart airline. It's just a very different economic equation. It's great investment grade risk. It's challenging non-investment grade risk. Now, the impact of that, if you look at the investment grade market today, which is about $11 trillion, it's up from about $3 trillion 10 years ago. That's really dominated by the financial services companies. The biggest issuers are JP Morgan, B of A, Wells, Morgan Stanley. The top 7 are all banks. If the predictions about the AI data center boom are correct, and the capital needs of the $5 trillion that I just mentioned will come through, you're going to look at the IG marketplace in the next 5 years. The top 10 will be very different. It will have Meta, it will have Amazon, it will have Microsoft. If they do pursue that path of funding, which is it's one of the largest, deepest markets, 11 trillion, they're going to have to access that. So when we step back and think about the next 3 to 5 years, we think about how the investment grade public market is going to change in context and risk. It's one thing financing some of the great financial services and banks in the world. Post-GFC, our banks and our financial services companies are the strongest, healthiest in the world. You don't mind being a debt lender to those. These other companies are taking business models that have been amazing business models, that have been asset-light business models, that have generated tremendous amounts of cash flow, and they're just changing the risk of being a lender to those companies. It's not bad risk, it's just different risk.
It sounds like this year was the year of credit. We were talking about how the 2025 banner year was credit. It sounds like next year isn't going to be. It sounds like next year the investment is in something that is more revenue stream based, that is maybe more equity driven, that isn't as leveraged to the story that you're talking about, which is an increasing glut of issuance, potential sticky inflation, and a Fed that's not that accommodative.
I actually take the other side of that. I think it's actually a tremendous time to be in credit.
There we go.
I think this is all about dispersion. It's picking the right names from the wrong names. It's about, people in credit are focused on credit, whether it's IG, public, high yield, private, and it's the dispersion that we've been waiting. If you're a 40-year veteran of this business and have built a massive credit platform, we like dispersion. We like being in the middle of trying to pick the winners and losers, because at the end of the day, that's just good credit picking. And I do think you're getting rewarded with base rates between 3% and 4%, and the clearing price for a lot of this CapEx for these data centers going to be more challenging. That's when you can actually earn your keep by being a smart investor.
Do you think we're heading into a distress cycle?
I don't see it. Listen, we are one of the largest historical players in the distressed arena. If you look at the numbers in the last 12 months in the loan market and the high yield market, they've actually come down in terms of the default rates. They were a little bit north of 3-4%. They've actually declined. So on a $3 trillion plus high yield and loan market, defaults of 2.5-3%, that's 60 to 90 billion. I don't see an overwhelming amount. Now, what I do see is I think you're going to get more secular distressed than cyclical distressed. And that's very important. When we think about secular distressed, I think that the development of AI will change broad business models. If we've talked a lot about healthcare technology, we've talked a lot about, the outsourcing businesses, we've talked about software, enterprise software. The AI impact can have dramatic impact on those business models. And typically, when you go back in the underwriting memo and you think about your base case and your downside being down 5, 10, 15%, when you have secular dislocation, you've missed the downside by multiples. And that's what you're probably going to have. But again, I think it's a great question, because I think a lot of the topics that are being discussed right now about the role of banks and private credit or the transparency of private credit, they're legitimate questions, but the bigger questions are, it's been a long time since we've had a credit cycle. We're gonna have a credit cycle. That's normal, it's natural, it's a cleansing process of capitalism. And again, I think that when you have a business like we've been in, where you have many companies that are more upstarts, we've been doing this, I've been doing it for 40 years, we've been doing it at Apollo for 35 years. I feel comfortable about our ability, but you've got some tourists in this space, no doubt about it.
And Jim, that question of affordability very much in the focus point, not just for the Federal Reserve, but also for the federal government. From the Fed's perspective, how much is it seeming like the logical step to cut rates in response to affordability concerns at the lower end of the consumer base?
I know you've had Torsten on recently to talk about this. I do think the K-shaped economy and the demographics of that, it's really having an impact on the transmission mechanism of Fed policy. I do think the last 3 to 5 years you've seen, whether it was this emergence of the K-shaped economy and our demographic shift of income and wealth, along with the evolution of our banking system, the evolution of dispersion, securitization, private capital, I think that's blunted the impact on monetary policy. And so, while I understand the impact of the view that rates are a bit higher than the nominal rate right now, or the neutral rate, excuse me, I just don't see a huge, other than confidence in the equity market, I don't see a reason to cut rates dramatically. But I do think there's no doubt this affordability issue. We saw it in New York. We saw it in the national. We saw it in the various elections around the country, Virginia and other places. It's going to be a topic for this administration to deal with.
Absolutely. And we've seen them actually backtrack on some issues because of it. Torsten Flock actually published this morning talking about significant fiscal boost coming in 2026 when it comes to the One Big Beautiful Bill. 2025, it was a lot of uncertainty. At least that's how people were viewing Washington. What do you view Washington for 2026? What's most important for you?
Well, I think that certainly it would be interesting to see what happens with the Supreme Court and the tariffs. I still think there's a lot of domestic initiatives in terms of large industrial capex. But from our perspective, this administration, when you look back at it, you really have 9 to 12 months to really get most of your activity done, and then the activity will be on the midterms next year. So I think that their ability to move in large swath domestic activities is going to be much more limited than it was this year.
So it's more of a wait and see how
I think
economy digests it.
Yeah,
Do you think they'll take more equity stakes?
I don't have a view on that in particular. They've had a handful. Certainly they need to deal with some of the domestic issues with regard to chip manufacturing in the U.S. A lot of the activities that were approved in the CHIPS Act with the prior administration have not been put to work. So that's an ongoing need for national security and other reasons for them to deal with. So that would be on the agenda in terms of manufacturing. but I'm not sure I see a lot of equity stakes as part of the plan.
I know you can't comment on potential live deals. There is this Paramount offer for Warner Brothers. It would be financed by Apollo, according to reporting. Do you see this environment, the regulatory environment, ripe for deals in a lot of these spaces?
You know, I think there's a reason why the M&A market will have a near record performance this year in terms of volume, north of $5 trillion. Certainly you have an administration that's much more comfortable with large industrial mergers, and certainly those larger transactions are able to garner very large financing packages. People want to invest in high quality companies, and certainly whether it's industrial consolidation or media consolidation, those types of activities garner a lot of attention and confidence.
Is there a lot going to get done between now and the end of the year, or is everyone pretty much packing it up, putting their crystal balls on and saying, look, we're going to the beach?
No, I think, listen, these are very robust markets. There's a lot of activity going on right now. The market will probably shut down in 2.5 weeks or so for a little bit of a global respite, and the predictions and the crystal balls will come out. But there's still a fair amount of activity going on, and I think the pipelines are fairly well built into the first quarter, so I would suspect a busy first quarter as well.
The crystal balls already are out, Jim. Come on, they already come out because people are looking for something to talk about. 2026 is already done and dusted. People are talking about 2027 at this point. Can you imagine?
We have to have people watch TV and sell newspapers, so it's important to all of us.
Stay with us. More Bloomberg surveillance coming up after this.
Sticking with the Fed ahead of next week's meeting, Lindsey Piegza of Stifel, clearly in the inflation camp of worries, writing, while inflation held steady in September, the lack of downward improvement from a still elevated level raises concerns that any further policy easing could risk an acceleration of price pressures. Lindsey joins us now. Lindsey, thank you so much for being with us. I want to start there. Why are you still concerned about inflation worries being the preeminent concern at a time when it seems like the Fed has moved more to the employment side of the equation?
Well, it does seem at least some Fed officials have shifted their focus away from price stability to full employment. But there are still a number of Fed officials that have come out to highlight the need to remain focused on reinstating price stability after years of allowing price pressures to remain above that 2% target. Now, we have made considerable progress in terms of reining in that growth in the aftermath of the pandemic, but we've never been able to get back to that point of price stability. And now, with this lack of downward momentum, it does suggest that the Fed might have reached a neutral position in policy, appropriate now to take a position, a sidelined position, without further rate cuts, without further risk of inciting inflation. Particularly now, there are a number of upside risks as we look out to the end of the year and turn the calendar page into 2026. So now is not the time to entirely divert focus away from achieving price stability.
Lindsey, do you think that the Fed has enough information and data, given what happened with the government shutdown, to make a decision next week?
I think the Fed has a good read on what's happening in terms of the underlying momentum in terms of cost pressures. Again, we haven't seen necessarily all of the data move to the upside, but we haven't seen any indications of a material downward momentum in inflation. And as such, I do think, coupled with the fact that consumer still remains on far from robust but solid footing, the economy is on track for a plus 3% growth pace. And we continue to see, again, not robust, but positive, solid job creation. I think the Fed should err on the side of caution, moving to the sideline, allowing for a further understanding of the evolution of both the price and the labor data before making any additional policy adjustments.
Lisa brought this up earlier, if potentially it's a hawkish cut. But what you're describing is maybe we have a dovish pause next week. Is that correct?
Not necessarily a dovish pause. I think we're looking for more of a neutral pause. I think the Fed at this point is pretty well divided between those that have that lingering fear of price pressures and those that are facing this emerging concern of weakness on the labor market front. So I do think the Fed could very clearly articulate a neutral pause, push policy to the sidelines, say we're not going to make any unnecessary movements until we have a better read on prices and the labor market, given there are risks to both sides of the Fed's dual mandate.
Lindsey, when you say inflation pressures are still in the system, there is a real question of what those inflation pressures look like. 3%, a lot of people say we can handle. 4%, not so much. How much are you seeing an actual unmooring of inflation expectations in a way that feels unsustainable and unduly punitive rather than 2.5%, say, or 2.8%?
Well, I think at the current read, right around 2.5-ish%, I think the Fed would be willing to tolerate that longer term. But my concern is these upside pressures that are still coming down the pipeline. Should we see a stronger than expected growth profile at year end, or a stronger, more spendy consumer as we now enter this key holiday shopping season, or turning the corner into 2026, should businesses now begin to pass through more of those cost increases to the end consumer that were previously absorbed into the bottom line, now that inventories have been drawn down significantly, any one or a combination of those factors could add significant upward pressure to inflation going forward. So it's not necessarily where we sit right now, but the risk to price pressures as we look out to the remaining months, the remaining weeks, of the year and into 2026.
Lindsey, just real quick here, going forward, I'm curious how effective you think monetary policy really is in tackling some of the issues that are preeminent, particularly when it comes to the K-shaped economy and questions around just how much wages are not keeping pace at the lower end.
Well, wages still are relatively positive. We see about this 4%-ish, but you're right. A lot of that growth has been isolated to the upper end of the income spectrum, fueling a lot of the activity on the retail side in the upper echelon. And so we don't see necessarily this broad-based expenditure. When we talk about the consumer being solid, we do have to be somewhat careful painting with a broad brush, because a lot of that momentum has come from this underlying increase in asset valuations, fueling trillions, tens of trillions of dollars in wealth. But again, that's very much isolated to the middle or the upper end of the income spectrum, as we're talking about property ownership, participation in the equity market, which those at the lower end, statistically speaking, are less likely to own property or have a stake in the equity market. So we do see, again, not necessarily the Fed's ability to completely ameliorate this K-shaped recovery, but there is a role of monetary policy, but a delicate one. We have to make sure that we're attentive to both that labor market and the price data components of that recovery.
Stay with us. More Bloomberg surveillance coming up after this.
Stocks edging higher following a weak start to the trading month. Katy Kaminski of AlphaSimplex Group writing, rate cut optimism has boosted small cap and mid cap stocks more than AI and big tech. Overall investor sentiment has stabilized, but fears still remain for overvaluation. Katy joins us now. Katy, I wanted to start with your understanding of what actually has been happening in markets over the past couple of trading sessions. It seems like there is an increasing breakdown in risk led by Bitcoin, maybe a bit of a stabilization. But from a technical standpoint, what do you see?
This is a good point, because what we have seen, you've definitely seen a breakdown in some of the recent trends. There has been a shift in sentiment overall, and you're starting to see some deterioration in some of the key themes. Of course, gold being something that has been selling off today. And it is also surprising that you're also seeing yields higher when rate cut optimism should be a positive for them. So I think that just highlights the amount of uncertainty and the potential for risk-off sentiment when people are concerned about high valuations.
One thing that really I was looking forward to speaking with you, Katy, because when you're following trends, sometimes you can find the pivot points and understand there is something different here. We're not going to see maybe the melt-up rally that we typically do in December heading into year-end. Are you sensing that there is some sort of pivot going on under the hood in markets?
Well, this is a very good point, because technically December is generally one of the better months for equity markets. There tends to be a lot of positive sentiment. But I think in the backdrop of some tepid economic information, some weaker labor data, people are getting a little more nervous. So there is some indication, at least with some of the price reversals that we've seen. I think some of these other asset classes like Bitcoin, even now gold selling off some, suggests that there is chance for some deterioration deterioration in equity markets.
Katie, is it Japan, ISM, the waiting on IEPA, or is the market just basically looking for an excuse to hold pat at the moment, especially when there's a number of questions still going into year end, most notably the Fed next week?
This is a good point because there's not a lot of data to hang on to. There's definitely mixed data. And I think with concerns of overvaluation and just how exposed many investors are to these themes, there is some clear uncertainty there. But what's interesting to me is you see like small cap has been doing a lot better, for example, than big tech. And that's just a little bit of a reversal from what we've seen typically this year. So you're just seeing a little bit of pivoting, a little bit of changing direction, would suggest that we might be in for a change in trend moves at some point.
Lisa pointed out that the PCE data we're going to get on Friday is very stale. This is from September. So when you look at the data coming out, what do you want to hang your hat on?
That's a good question. I mean, obviously, we'll start to get more data next week. I'd say that there's not a lot for investors to hang on to at this point. And it really is sort of the end of the year, which tends to be a very positive environment. So I think they're focused much more on sort of following the narrative for rate cuts for next week. That seems to be the only major thing to follow and see what's going on. But you're correct. There's not a lot of very pivotal data that's going to help us figure out what's really going on.
Well, this goes back to something you were saying earlier. If you're following rate cuts, why are yields rising?
Exactly. I mean, I would guess that that's probably a reaction to what is going on in Japan. Clearly, we saw the potential for hikes there causing treasury yields to move upwards. Besides that, I mean, it is slightly counterintuitive for yields to be rising going into a potential for rate cut. But this just may have to do with some of the uncertainty. I know that there's been a lot of discussion about disagreement within the Fed, so that may be causing a little bit of jitters in the bond markets.
Yesterday, we did see 10-year and 2-year Japanese bond yields reach the highest levels that we've seen going back to 2008. The expectation was that you were going to see a rate hike at the next Bank of Japan meeting. That said, earlier in the morning, it wasn't when we saw the yields creep higher. It was after the ISM manufacturing data. And then, as Cameron Dawson was pointing out, it was after the story about Costco potentially laying the groundwork to reclaim some of the revenue, some of the tariffs that they paid over the course of this year in the case of a Supreme Court ruling. Which of these narratives makes the most sense to you, or do you think that there's something else entirely?
Well, really, it's very tricky, right? Because you have market moves that seem counterintuitive to general macroeconomic themes, such as the Fed rate cuts. Then you have, Japan, which is moving in a different direction. And as you just pointed out, you're also seeing some weakness in labor data and manufacturing, which paints a more concerning picture about the general U.S. economy. And especially if you're thinking about long-term bonds, there may be some questions of whether or not rates can stay low for long if we sort of don't know what's going on next. So you're right. It's very tricky right now.
When you start thinking about the Fed meeting next week, the market is baking in this idea of another interest rate cut, but you're talking about maybe some disagreement at the Federal Reserve. Do you think there's a potential that they stay pat and on pause?
Right now, the market is not thinking that, but given the level of disagreement, the level of uncertainty, and the wide range of potential outcomes, I think we haven't had this level of disagreement in the Fed for almost 13 years or longer. So just given that sort of range of outcomes, there's always a probability you're going to have more disagreement or more disappointment than if you have a lot of consensus on the Fed.
If the Fed does pause and does not cut interest rates, will there be a Santa rally as Lisa started the program off this morning?
Oh, that's a good question. I mean, that could definitely put a pause on a Santa rally because you look at how small cap U.S. stocks have really reacted. There's clearly that would be a headwind for many equity investors. And I do think that could be a potential negative for equity markets should they not deliver as people expect.
Stay with us. More Bloomberg surveillance coming up after this.
The National Retail Federation forecasting 2025 holiday sales to exceed $1 trillion for the first time. Joining us now, I'm so pleased to say, is Matt Shay, CEO and president of the National Retail Federation. Matt, thank you so much for being with us. First, I just want to get a sense of how much that $1 trillion figure and how much some of the increases that we've seen in sales during this holiday shopping season have really stemmed from just higher prices, not necessarily a greater degree of volume.
Well, good morning. Happy to be with you today to talk about the big holiday weekend on Cyber Tuesday now. But we had a great weekend. We had tens of millions of Americans out shopping. We're going to be releasing the results of the weekend on our holiday call at 11 o'clock this morning, 11 Eastern. So I think what we saw was retailers delivering real value to consumers. And while there have been some price increases throughout the system, through this whole year, retailers have worked very, very hard to keep delivering value for customers and to avoid passing on any price increases. So we're looking at maybe 1% price increases on food. And really for the last couple of years, we've been seeing on the good side flat to down on inflation. So there's real growth there with a 4% forecast. Our forecast 3.7 to 4.2%. We'll see real growth this year. And I think you saw some great deals over the weekend and saw some retailers that were really winning with customers.
So let's talk about this period of discounting. It was Black Friday, then it was Cyber Monday, where actually there are potentially steeper discounts, averaging 31% compared with 28% on Black Friday. Now we're on to, let's go teetotaling Tuesday or something. I mean, it seems like it's just continuing in terms of the sales and the promotions. Does that indicate that retailers are looking to clear their shelves? So does that indicate that there just is a need to generate eyeballs? Or is it just that they feel like they want to give a sense of value to their customers?
Well, I think there are a couple of things happening here. First of all, I think we begin with inventory levels. And inventory levels are in a very good place on a historic basis. So we're about 1.13, which means we've got a little more than a month's supply for a month's worth of sales. So they're not holding too much inventory. They've got the right inventory in place. I think it's a very competitive retail environment. Consumers are under some pressure at the lower end, but they're still out there spending. And we're on track to have a very good year overall, probably in the 4% range for the year. And what we're seeing is consumers are being very deliberate, very thoughtful, very purposeful. They've got lots of information at their fingertips. They're really looking for the best deals they can find, the best value based on the things they need and want. So I think what we see is a competitive landscape, inventory levels in a good place. Margins are holding up very well for retailers across the board. And the promotions we've seen have been planned promotions. So there's this is all part of a planned rollout for the holiday season. And I think thus far it's going really well. We're off to a great start for the 5-day holiday weekend here for Thanksgiving.
Matt, to Lisa's point, though, maybe we call it Tardy Transaction Tuesday. I am getting nonstop emails this morning about how Cyber Monday has been, quote, extended. And to be honest, I actually took advantage of them very early this morning, something I forgot I wanted to purchase. Are you saying that is all planned and this basically just becomes a discount week? Or does it actually show that these retailers are really desperate to try to get eyeballs and individuals back on their sites?
Well, I think, Anne-Marie, I think one thing we've seen is the holiday season has been extended over the last several years. And certainly since the pandemic, we've seen consumers beginning their shopping much, much earlier than was traditionally the case. And we see retailers delivering those deals all the way back into the summer and throughout the fall. So what we're seeing now, I think, is a continuation of that. They're going to continue to be day by day, week by week, different kinds of promotions, different kinds of rollouts that are going to be designed to attract consumer engagement throughout the holiday season. And I think that this has all been this is a thoughtful series of deliberate sort of promotions that are out there. They're planned. They're responding to what consumers are looking for. And I think back to the competitive landscape that we're operating in, we're not in the period where every retailer is a winner. And every business is going to win the way we saw in 21, 22, 23 even. This is an environment in which it's much more competitive. And so retailers are trying to distinguish themselves in the marketplace, deliver that real value. And value is I think more complicated. It's not just price. For some consumers, value is price, but it can be quality, it can be selection, it can be convenience when it comes to fulfillment, delivery. So when consumers say they're looking for value, they're looking for something that makes them feel they got what they paid for. And that might be a great quality item. That might be an item that gets delivered more quickly than they could get it from another competitor. So I think there's a whole series of things that we use when we say value. We're talking about a series of different kinds of experiences based on the consumer. And again, we'll talk more about this at 11 this morning, but we saw retailers really delivering value through this weekend. The numbers were good. Traffic was good online, in store. So I think we're off to a very healthy holiday season.
Stepping away from the holiday season for a moment, can you give us a sense of how retailers are dealing with tariffs and this potential of IEEPA being struck down? Are they talking about potentially benefiting for the reimbursements that might be needed to be paid back to them if the Supreme Court deems that IEEPA was illegal?
Well, I think what we've seen this year, and again, going back to the pandemic, we've seen for the last 5 years, this great period of disruption, this period of uncertainty, unpredictability, even volatility across the market, things that are outside the control of a retail business or any business for that matter. And so I think as we look forward, retailers, again, are focused on the things they can control. And what they can control, the relationship with their partners, their suppliers. They can be creative and thoughtful about the way they're handling their sourcing, their inventory, their importing, the way they're communicating with customers. Those are all things they can control. What the court does or doesn't do when it finally issues a decision on the tariffs, I think that's something that we can't control, our members can't control, and we'll handle that when we get to it. So I don't think anyone's counting on a result one way or the other. It's what we're looking for is certainty, predictability, something that'll smooth out the relationships in the supply chain. And the court will make a decision, and we'll certainly go from there based on what the court decides.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.